put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. The document that erased $150 billion in 72 hours. In January 2023, a single document landed like a bomb in the heart of India's financial markets. 186 pages of allegations, forensic analysis, and accusations that would wipe out $150 billion in market value in a matter of days. The target? Gautam Adani, a man who had quietly built an empire so vast, so interconnected with India's infrastructure, that many believed he was untouchable. But the report claimed to have found something lurking in the shadows of his conglomerate, evidence of what investigators called the largest con in corporate history. This is the story of how a short seller's research document became the weapon that nearly destroyed a dynasty, and the question that still haunts India's financial markets: was it the truth or the perfect assassination? Gautam Adani's rise reads like a fever dream of ambition. Born in 1962 in Ahmedabad, Gujarat, he was the son of a textile merchant. Nothing about his early life suggested he would one day control India's ports, airports, power plants, and coal mines. He dropped out of college, started as a diamond sorter in Mumbai, then returned to Gujarat in 1981 to start a commodities trading business with borrowed money. It was the beginning of something that would grow far beyond anyone's imagination. By the 1990s, Adani had secured his first major breakthrough: management of the Mundra port in Gujarat. It would become India's largest commercial port. From there, the empire expanded like a shadow stretching across the country. Coal mining, power generation, renewable energy, airports, data centers, defense manufacturing. The Adani Group became synonymous with India's infrastructure itself. By 2022, Gautam Adani had become the world's third-richest person, with a net worth briefly touching $155 billion. He had surpassed Warren Buffett. He was closing in on Elon Musk and Jeff Bezos. But there were whispers about how someone could grow this wealthy, this quickly, in a country where regulatory approvals moved slowly and competition was fierce. Questions about his relationship with Prime Minister Narendra Modi, a fellow Gujarati whose political rise had coincided almost perfectly with Adani's business explosion. Critics called Adani Modi's Rockefeller, the billionaire who had become inseparable from state power. When Modi traveled abroad, Adani's private jet often followed. When the government privatized airports, Adani won the bids. When coal blocks were auctioned, Adani secured them. It was a symbiosis that seemed too perfect to be coincidence. The stock market loved the Adani story. Between 2020 and 2022, Adani Group stocks soared by as much as 800%. Retail investors piled in. Institutional funds added Adani stocks to their portfolios. The narrative was intoxicating. India's infrastructure boom personified in one man's relentless expansion. But beneath the surface, forensic analysts were noticing something strange. The company's debt levels were astronomical. Their cash flows didn't seem to justify their market valuations. And most puzzling of all, the majority of shares in Adani's listed companies were held by obscure offshore entities that seemed to exist only on paper. Someone was watching, and they were building a case. Hindenburg Research is not a traditional investment firm. Founded by Nathan Anderson, it specializes in forensic financial research and short selling, betting against companies it believes are overvalued or fraudulent. Hindenburg had made its name exposing Nikola, the electric truck company whose founder was later convicted of fraud. It had taken down Clover Health, revealing undisclosed government investigations. Now it turned its attention to India. For 2 years, Hindenburg's researchers quietly gathered evidence. They interviewed former Adani Group executives. They analyzed thousands of documents. They traced the ownership of offshore shell companies in tax havens: Mauritius, the British Virgin Islands, Cyprus. What they found, they claimed, was a scheme of staggering complexity. On January 24, 2023, Hindenburg published its report. The title was direct: Adani Group, How the World's Third Richest Man is Pulling the Largest Con in Corporate History. The allegations were devastating. Hindenburg claimed that Adani had used a web of offshore shell companies to artificially inflate stock prices, that the companies engaged in stock manipulation, creating phantom demand for their own shares, that the group's debt was being hidden through accounting tricks, that related party transactions, deals between Adani entities and companies secretly controlled by Adani family members, were being used to siphon money out of publicly listed companies. The report identified 38 Mauritius-based shell companies that Hindenburg claimed were controlled by Adani's brother, Vinod Adani, but publicly presented as independent investors. The allegation was clear. The Adani Group was using these entities to manipulate its own stock prices, creating the illusion of independent investor confidence. The market's reaction was immediate and brutal. Adani Group stocks went into freefall. On the first day, the 7 listed Adani companies lost $17 billion in combined market value. By the end of the first week, the losses had exceeded $50 billion. Gautam Adani himself lost $21 billion in personal wealth in a single day, one of the largest single-day wealth destructions in history. Panic spread through India's financial system. The Adani Group had over $30 billion in debt. If the conglomerate collapsed, it would take down banks, bondholders, and institutional investors with it. The Reserve Bank of India quietly began monitoring systemic risk exposure. The nightmare scenario was unfolding. A corporate empire that had become too big to fail was now failing in real time. But this is where the story enters its darkest phase. Because what happened next wasn't just about money. It was about power, about the collision between global capital and national sovereignty, about whether a single research report could bring down a man who had built his fortune in the shadow of the state. The Adani Group's response was swift and aggressive. They released a 413-page rebuttal, calling Hindenburg's report a malicious combination of selective misinformation and stale, baseless, and discredited allegations. They claimed Hindenburg had a financial motive. The firm had taken a short position, meaning it would profit from Adani's stock collapse. They accused the report of being timed to damage Adani Enterprises' upcoming $2.5 billion follow-on public offering. But the rebuttal didn't address many of Hindenburg's specific allegations. It didn't explain the offshore entities. It didn't clarify the complex web of related party transactions. The market noticed. The selling continued. Then came a moment that revealed just how deep this crisis went. Adani Enterprises was forced to cancel its $2.5 billion share sale, the largest follow-on public offering in Indian history. The company claimed it was returning the money to protect investors from volatility. But everyone knew the truth. Institutional investors had fled. The offering had failed. And with it, Adani's ability to raise new capital to pay down the crushing debt. By early February, the Adani Group had lost $150 billion in market value. Gautam Adani had fallen from the world's third richest person to somewhere outside the top 10. His net worth had been cut in half, but he hadn't been destroyed. Not yet. What saved Adani was what had made him powerful in the first place: his connections. India's banking system, heavily exposed to Adani debt, had every incentive to prevent a collapse. State-owned banks continued to support the group with credit lines. The Securities and Exchange Board of India, India's market regulator, launched an investigation, but moved slowly. More importantly, Adani's core assets, the ports, the airports, the power plants, continued to generate cash. These weren't phantom businesses. They were real infrastructure assets with real revenue streams. The stock prices might have been inflated, but the underlying businesses were functional. This was the paradox at the heart of the Hindenburg crisis. Was Adani a fraud, or simply an over-leveraged businessman caught in a short seller's crosshairs? The answer, it seemed, depended on who you asked. By March 2023, something unexpected began to happen. Adani stocks started to recover. Slowly at first, then with gathering momentum. The panic selling had stopped. Indian retail investors, many of whom viewed Adani as a symbol of national pride, began buying again. The narrative shifted. This wasn't just a financial crisis anymore. It was being framed as an attack on India itself by foreign short sellers. Social media campaigns portrayed Hindenburg as part of a Western conspiracy to undermine India's rise. The Indian government, while officially remaining neutral, sent subtle signals of support. Prime Minister Modi continued to award major infrastructure contracts to Adani companies. The message was clear. Adani was too embedded in India's strategic infrastructure to be allowed to fail. But here's where the story takes its second dark turn. Because even as the stocks recovered, even as the immediate crisis faded, the fundamental questions raised by Hindenburg remained unanswered. Who really owned those offshore shell companies? Why were Adani stocks trading at valuations that bore little relationship to traditional metrics? How had a family-run conglomerate grown so large, so fast, with so little independent oversight? India's Supreme Court eventually ordered a regulatory investigation. The Securities and Exchange Board of India probed 24 entities allegedly linked to the Adani Group. In January 2024, nearly a year after the Hindenburg Report, SEBI announced its findings. It found no evidence of stock manipulation by the Adani Group, but it also couldn't definitively disprove Hindenburg's allegations. The opacity of offshore structures, the complexity of the transactions, the limits of regulatory jurisdiction, all made conclusive findings impossible. The case remained in a legal and financial limbo. What makes this story a true business thriller isn't just the allegations or the market collapse. It's what the Hindenburg crisis revealed about the nature of modern wealth and power. Adani had built his empire through a mixture of legitimate business acumen, strategic political relationships, and aggressive financial engineering. He understood that in emerging markets, the line between business and government is often blurred, that infrastructure development is inherently political, that he who controls the ports, airports, and power grids controls the country's economic arteries. The Hindenburg Report exposed the fragility of conglomerates built on debt, leverage, and complex corporate structures. But it also revealed something more troubling: the difficulty of holding such empires accountable. By late 2024, Adani had staged a remarkable comeback. His companies had regained much of their lost market value. His net worth had climbed back above $80 billion. He secured new contracts, a cement deal, renewable energy projects, port expansions. The group repaid billions in debt ahead of schedule, demonstrating financial resilience. Major international investors, including Total Energies and IHH Healthcare, maintained their partnerships with Adani entities. The message was unmistakable. Adani had survived. But then, in November 2024, a new crisis emerged. This time, it wasn't a research report. It was a U.S. federal indictment. U.S. prosecutors charged Gautam Adani, his nephew Sagar Adani, and senior executives with orchestrating a $250 million bribery scheme. The allegations claimed Adani officials bribed Indian government officials to secure solar energy contracts worth billions of dollars. The indictment detailed meetings, PowerPoint presentations, and encrypted communications, allegedly showing the conspiracy. It was a bombshell that made the Hindenburg allegations look like a warm-up act. This wasn't about stock manipulation or accounting opacity. This was a criminal case brought by the US Department of Justice. Once again, Adani stocks plummeted. Once again, international partners reconsidered their relationships. Kenya cancelled a $2 billion airport deal with Adani. Bangladesh launched investigations into Adani's power projects. The pattern was repeating, but with higher stakes. The Adani Group denied all allegations. They called the charges baseless and vowed to fight them in court. But the damage was done. The US indictment transformed Adani from a controversial businessman into a globally scrutinized figure, potentially facing criminal prosecution. It raised questions about how far his influence truly extended. If the allegations were true, it meant Adani had been bribing government officials to secure contracts, a practice that would make his entire renewable energy division's revenue potentially tainted. If false, it meant he was the target of a coordinated international campaign to destroy him. Either way, the dynasty he had built was under siege. What the Hindenburg Report and subsequent US indictment reveal is a fundamental truth about modern wealth accumulation. At the highest levels, business is inseparable from power. Adani's rise was enabled by his proximity to government. His ability to secure contracts, approvals, and regulatory clearances faster than competitors wasn't just business savvy. It was access. In India, as in many countries, infrastructure development is inherently political. The state decides who builds the airports, who manages the ports, who gets the coal blocks. Adani understood this game better than anyone, but that same proximity to power made him vulnerable. When you build an empire in the shadow of the state, you inherit the state's enemies. The lesson here isn't simple. It's not a story of a villain exposed or a hero vindicated. It's a story about the complexity of economic power in the 21st century, about how conglomerates can become systemically important even while their accounting remains opaque, about how nationalist sentiment can shield businesses from scrutiny, about the tension between foreign short sellers and domestic economic sovereignty. Adani's story forces us to confront uncomfortable questions. Can you build a fortune this large without bending rules? Should businesses this important to national infrastructure be allowed to remain family-controlled and lightly regulated? When does aggressive financial engineering cross the line into manipulation? These questions don't have easy answers. As of today, Gautam Adani remains one of the world's richest men. His companies continue to operate India's critical infrastructure. His airports handle millions of passengers. His ports move billions of dollars in cargo. His power plants keep lights on across the country. The Hindenburg allegations haven't been fully resolved. The US criminal charges are pending. Multiple investigations are ongoing. But Adani has demonstrated remarkable resilience. He has survived crises that would have destroyed lesser businessmen. Whether that's because he's innocent or because he's too powerful to fail remains an open question. The real question isn't whether Gautam Adani is guilty or innocent. The real question is what his story tells us about how wealth and power actually work, about the systems that enable certain individuals to accumulate fortunes so vast they become inseparable from national infrastructure, about the difficulty of regulating businesses that operate across borders through shell companies in jurisdictions designed for opacity, about the limits of accountability when someone becomes too big to fail. The Hindenburg Report didn't destroy Adani, but it exposed the architecture of his empire. And once you see that architecture, the offshore entities, the related party transactions, the debt structures, the political connections, you can't unsee it. In January 2023, a 186-page document landed like a bomb, threatening to destroy one of the world's greatest fortunes. 2 years later, that fortune has survived, battered but intact. The dynasty continues. The questions remain. And somewhere in tax havens across the world, shell companies with names like Emerging Market Investment D, MCC, and Vespera Advisory still hold shares in India's airports, wondering if anyone will ever truly know who owns them. That's the real darkness at the heart of this story. Not what was exposed, but what remains hidden. The secrets that even a 186-page forensic report couldn't fully uncover. The truth buried so deep in corporate structures that it may never see light. Welcome to the dark side of business, where empires are built in shadows and dynasties survive by becoming too essential to fall. Subscribe and listen to our next story below.